Hello and welcome. My name is Partho Mujumdar. In this video, we will discuss about the put option. Now you would know that there are two kinds of option. One is called the call option, and in this video we will discuss the put option. Now a call option is utilized when we want to buy a security, and a put option is utilized when we want to sell a security. Now the security that we buy or sell in an option is the underlier. We do not actually trade with the actual security. The security could be a stock or a bond or a commodity or currency. The currencies could be like USD to INR or USD to Japanese yen. Commodities could be like iron, steel, cotton, agricultural products, etc. So we do not deal with the actual security like a stock or a bond or a commodity, but we use these securities as an underlier. So in a option, we will never actually be holding the security. Like if we trade in a option using stocks, we will not be actually holding the stock. Instead, we will be utilizing the stock as an underlier and doing the trade. So whatever are the proceeds from the trade, we will get the proceeds without actually holding the security. So in any options trade, we will have a buyer and we will have a seller. So we will have a buyer and we will have a seller. So either if it's a call option or a put option, I will either buy a call option. When I'm trying to buy a call option, I have to find a seller who will be ready to sell the call option. Similarly, in a put option, I will have to buy a put option, and when I am buying a put option, I have to find a seller who is ready to sell the put option. So basically, the put option or a call option or any option is basically a financial contract between a buyer and a seller. In this financial contract, we will enter the certain conditions which we will discuss. So in that case, either the buyer makes a profit or a seller makes a profit. If the buyer makes a profit, the seller makes a loss. If the seller makes a profit, the buyer makes a loss. Now let's get into discussion regarding specifically about the put option. So the put option is a right of the buyer. So it's a right of the buyer, but it's not an obligation. What does it mean is that if a buyer wants to enter into a contract to sell a stock, let's say stock is an example for us. It can be commodities, it can be currency, whatever else also. So here, if we use the stock as an underlier, so if a buyer wants to sell a stock at a price within a specified period, then the buyer has the right to make a sale or not to make a sale. However, the buyer is not obliged that if he enters into this contract, he must definitely make the sale. So here the buyer has the right but not the obligation. Now, when the buyer enters into a put option contract, he basically tells the seller that I will sell at this price. The price of what he sets is known as the strike price. So he will say that at this price I'm going to make a sale. So if the buyer enters into a contract to the seller in a put option on a strike price, then if the buyer exercises the right to sell, the seller will be obliged to make the purchase. So here the buyer of the put option has the right but not the obligation. However, this contract will have a period of time for which it will be valid, and that period is known as the maturity period or the expiry period. So this is the maturity of the expiry. Now for this right, what the buyer gets from this put option contract, the buyer gives the seller a premium. So a premium is agreed between the buyer and the seller that the buyer will pay this premium to the seller for exercising his right in this put option. The buyer will always consider using a put option when he expects the price of the security to fall. In this case, if he expects that the price of the stock will fall, then the buyer will exercise the put option or he will enter into a contract for the put option. Now we will see that if the stock price falls below the strike price, then the buyer will definitely enforce the put option. If the price rises above the stock price or remains around the stock price, he will not exercise this put option. We will see this through an example. Let's take an example of Tata Consultancy Services shares on 17th of July 2023. Here I have plotted a small portion of the intraday chart for you on 17th of July 2023. So here what you see that the stock has been moving throughout the day, and the buyer sees that the stock was below the moving averages line. So this is the moving averages line. So buyer sees that the stock was, let me just change the color. So this is the moving averages line. The buyer sees that the stock was below the moving averages line at about 3510.75, and then it started rising. So he has a speculation that it will fall below the moving averages line once again. So when the stock reaches this point at 35.42, he thinks that he will get into a put option. So at this point, the buyer buys a put option at a strike price of 35.42, and he gives the expiry of 1 day, and he buys 100 shares. So now in our options, we always have to trade in a lot. A lot is normally 100 units. It can be 1000 also, but normally it's 100 units. So when we say I'm going to buy 100 shares of TCS in a put option, basically I will be saying I'll buy one lot of TCS at a strike price of 35.42 with the expiry of 1 day. Now, once I make this decision, I need to find a seller who will be ready to enter into a contract on these terms with me. And also, I agree that with the seller that I will pay a premium of rupees 5 per share. So this is the trade which has been created by the buyer and the seller at the time T1. So at this point, they have agreed for doing this particular trade. At time T2, the buyer sees that the stock price is actually falling, and when it reaches this point 3516.19, he decides that he will make a exercise of the put option. So at this point, the buyer of the put option decides that he will exercise his put option contract which he has entered with the seller. So let us see what his profits are at this point of time. Now, as we know that put option is exercised when we expect the stock price to fall. So the stock price has fallen from here to here. So naturally, the buyer of this put option will make a profit. The profit will for the buyer will be the strike price minus the market price minus the premium what he has paid. So in this case, it will be 35.42 minus 35.16.9, where this is the strike price what he had entered, and this is the market price. This is the strike price what he had entered, sorry, and this is the market price, which is the current price at this point of time. And he has paid a premium of 5 rupees. So he makes a net profit of 20 rupees 10 paise per share. Since he had bought 100 shares, he makes a total profit of rupees 20,100 on this particular trade. So since the buyer has made a profit of 20,100 rupees, the seller will have a similar loss. So if you see the calculation on the seller's side, the seller is making a loss of 20 rupees 10 paisa per share. So that will result in 20,100 rupees loss for the lot what was traded in this particular put option. Now here, notice that even though the seller is making a loss, he is obligated to buy at the strike price what was quoted by the buyer. So the seller does not have a choice but to bear the loss when he is entered into a put option with the buyer. But the buyer, if the market was not favorable for the buyer could have just walked away from the trade. Now, in this calculation, what I have shown you, I have not considered the brokerage charges. There will be brokerage charges because both the buyer and the seller will have to exercise the trade through a broker. The broker will charge a brokerage to both the buyer and the seller. Now let us consider another example. Supposing a farmer thinks that the price of cotton will fall. The farmer has a huge quantity of cotton from his produce. So he thinks that the price of cotton will fall. So if he goes to the market with the cotton, he will get a less price for the cotton what he has got. So the farmer can exercise the put option. So let us say that the current price of cotton is 1000 rupees, 7000 rupees per quintal. Let's say the farmer buys a 1 month put option, that is a put option with a 1 month expiry at for 1000 quintals of cotton at 6900 rupees per quintal. That is the strike price at a premium of 50 rupees per quintal. This is a arbitrary example, but a real life scenario. Now, under this contract, under this put contract, which has been entered, he has found a seller. And now, let's say the price of the cotton has fallen to 6600 rupees per quintal. So, when the price has fallen, and since the farmer bought a put option, he will exercise the put option. If he exercises the put option, the profit for the farmer will be, this is a strike price at which we purchase, that is 6900. The current market price is 6600, and he paid a premium of 50 rupees per quintal. So the net profit per quintal is coming to 250 rupees for the farmer. And since he purchased 1000 quintals, so he will make a total profit of 2,50,000 rupees on this trade. Now, this 2,50,000 rupees, what the farmer makes from this particular trade, from this put option, he can utilize in the actual trading, because even if he suffers a loss of 2,50,000 rupees from the sale of the cotton because the price have fallen, he can get this money back from this put option what he has exercised. So this is a way merchants or farmers or other people, they benefit from the put options trade. Let us see another scenario. Suppose now, instead of the price fallen to 6600, the price has actually fallen to only 6875 rupees per quintal at the expiry of this particular trade which we just discussed. Now the cost to the farmer was rupees 6900 per quintal, that is the strike price what is set, plus 50 rupees was the premium what he was ready to pay. So his total cost per quintal is coming to rupees 6950. If the farmer exercises the put option, then his position will be that he has purchased at 6900 minus 6875 minus 50 premium paid. So he will suffer a loss of 25 rupees per quintal, or a net loss of rupees 25,000 rupees on this trade. Now the farmer has a option for him, that is he has the right to sell. He can decide whether he wants to sell or he will not sell. He is not obligated that he must definitely sell. So the farmer finds out if he doesn't sell, what happens to his position. See, the farmer doesn't exercise the put option, then he will have to still pay the premium, because this amount has been agreed between the buyer and the seller. So if the premium has to be paid by the farmer, then he will have a net loss of rupees 50,000 rupees, because 50 rupees premium for 1000 quintals will be coming to 50,000 rupees. So here the farmer sees that if he exercises the put option, though the price has not fallen decently, he will suffer a less loss as compared to if he does not exercise the put option. So in this case, the farmer will exercise the put option. Now let's take a third case. Now suppose that the price of cotton is 6925 per quintal at expiry. So this is the price of cotton at expiry. So the farmer, he has a position where he has spent 6950 per quintal. So if the put option is exercised by him, then you see that he suffers a loss of 75 rupees per quintal, because his strike price was 6900, the current price is 6925, and he has paid a premium of 50 rupees per quintal. So he will suffer a total loss of rupees 75,000 if he exercises the put option. However, we know that the farmer has a right, he can exercise the put option, or he can just walk away from it because he is not obliged. So if he walks away from it, all he has to do is that he has to pay the premium. That was rupees 50 per quintal. So his net loss will be rupees 50,000. So in this case, the farmer will just walk away from the trade and pay the premium and suffer a loss of 50,000 rupees. So there are certain things to be noticed here. First of all, the profits to the farmer is unlimited. So if the price of the commodity falls, or the price of the underlier falls, then the farmer will make unlimited profit. However, if the price rises above the strike price, then the loss of the farmer is restricted, and it is restricted to the amount of premium what he has agreed with the seller. Here you see the plot of the trade what we just discussed. So the buyer had set a strike price of 6,900, that is here, and he agreed for a premium of rupees 50. So the buyer's position is here that he has a total expense of rupees 6,950. So if the price of the commodity falls, so if the price of the commodity falls, you notice that the profits of the buyer keeps moving upwards. So at this point, if the price falls by 50 rupees, then the buyer is at a break-even point. So he neither makes a loss nor a profit. Same with the seller also at this point. The seller also doesn't make a profit or a loss. However, if the price of the commodity falls further, as the price falls further, the profit of the buyer keeps going upwards. Now, however, notice that if the price rises above the strike price, then the buyer will simply not exercise the put option and he will just pay the premium. So the loss is limited for the buyer. So you notice in this scenario that the buyer has unlimited profit from this particular put option. However, he has limited loss from this put option. The reverse is true for the seller. The seller has got unlimited loss from the put option, but he has limited profit from the put option. Ultimately, notice that the buyer will always exercise the put option if the market price is below the strike price. The put option is often utilized when we actually have the underlying commodity or underlier with us. Suppose now we take the same example of the farmer who is selling cotton, and instead of the farmer we consider a merchant who has actually purchased cotton at the price of 68.75 per quintal. So now here what has happened is that the merchant has made a purchase of the cotton, so the cotton is with the merchant. So now he has to sell the cotton. The cotton price, the merchant thinks that it could either rise or it could fall. So if the price of the cotton rises, the merchant will make a profit. However, if the price of the cotton falls, the merchant will make a loss. Now, the merchant, what he can do is that instead of purely relying on whether he will make a profit or a loss based on the market situation, he can purchase a put option. Supposing the merchant price bought this commodity at 68.75 rupees, that is here. So here, this is the price at which the merchant made the purchase of the cotton. What the merchant can do is that he will make a put option at a strike price of 6,900. So at this strike price, the merchant makes a put option. So now, and he pays a premium of 50 rupees. So the cost of this put option is 6,950, like we have discussed in the previous example. So now what happens is that supposing the price of the cotton falls, this is the first scenario. If the price of the cotton falls, let's say it falls to 6,700 rupees per quintal. So here, if he had just purchased the cotton and had to sell it at this particular point, he would suffer a loss. This is the loss what the merchant would suffer. Instead, what has happened is that he has purchased a put option, and in the put option, because the put option will give a profit when the price goes down, he is making a profit. That is, this much is the profit what the merchant is making from the put option. So if you see the calculations, so from the loss at 6,700, the farmer suffers a loss of 175 rupees per quintal. That is the purchase price of 68.75 minus 6,700. That is, he's suffering a loss of 175 rupees per quintal. However, from the put option strike price was 6,900. and the current market price is 6,700. He paid a premium of 50 rupees. So he gets a total profit of 150 rupees on the put option. Now he nets his position, that is, he takes the loss of 175 and the gain of 150 and sees that he has a net loss of rupees 25 rupees per quintal. So you notice that by using a put option against a commodity which he is holding, he has limited his loss. This loss of rupees 25 rupees per quintal will be the same irrespective of how much the price of the commodity falls. So he has restricted his loss to a certain amount. His loss cannot be below this much. I'm sorry, the loss cannot be more than this much. But on the other side, if the price of the commodity rises, and let's say it goes to 7,100 rupees per quintal, in that case, the gain from the rise in price for the farmer is 7,100 minus 6,875 or 225 rupees per quintal. And the loss from the put option will be the premium what he has paid, because since the price has risen above the strike price, the farmer will not exercise the put option. He will just pay the premium. So he will remove the premium from the profit what he is making, and he will make a profit of 175 rupees per quintal. So you notice here again, by using a put option against a commodity what he has got, he is going to get unlimited profit if the markets are favorable, but his losses are limited to a certain amount if the market falls. So in this case, the break-even point for the farmer for the merchant is at this point, which is 6,925. Now we have discussed the case with a commodity that is cotton, but the same is done for shares or stocks, etc. Supposing I buy a share of TCS and I have, let's say, 1,000 quantity of TCS shares, and I am not sure whether the price will rise or fall, though I am expecting it to rise. In that case, I can exercise the put option and protect myself against the losses. And if the price rises, I will make a profit. But if the price falls, I will definitely be protected against the fall of the price. So that brings us to the end of the discussion on put option. I hope you enjoyed it as much as I enjoyed recording it. Thank you for listening.